valuations and mergers and acquisition activity across the country, given what's happened the last 6 months. We've noticed a lot of things going on, obviously, that happened through March 31st, and then there's been the last 90 days. So because your time is precious, I want to kick this off and turn it over to Scott to walk you through what's going on with valuations. So Scott?
Thank you, Steve. Good afternoon, everyone. We're going to pop some slides up on the screen, and we're just going to run through them, and we're definitely happy to share these slides if you reach out to us afterwards. But I mean, really, valuations in general, valuation activity has been very strong for probably several years leading up to the first couple months of 2020. But as would be expected, there was a decline in activity that really is concurrent with the stay-at-home orders from this COVID-19 virus. That wasn't too surprising. What we saw broker owners really needing to focus on operating their business, and they really had to drop everything else they were doing. They needed to focus on engaging their agents, figuring out the technology, and preparing for the rebound. So anything else that was on their agenda for possibly getting a valuation, that was kind of put to the back burner. It wasn't due to lack of want or lack of need. It was really lack of focus on what they needed to do at the time. But also, as would be expected, we have seen activity picked back up over the last month or so. It's in fact been very strong, especially over the last 3 or 4 weeks, as we're starting to see the stay-at-home orders be lifted, and as we're starting to see activities return to semi-normalcy. We are seeing valuation activity increase. As we're seeing the valuation activity increase, it's for many of the same reasons that we're seeing before. The reasons for valuation really aren't changing all that much. Obviously, one of the bigger reasons for valuation is for firms that are preparing for a sale or interested in inquiring to see if that's an option in the near future. We're also seeing people order valuations for estate planning, for succession planning. That's a very common reason. Unfortunate reasons like death, divorce, partnership disputes. We're seeing some of that as well. That's always going to happen, unfortunately, just like taxes. We're also seeing a lot of, and probably one of the biggest reasons we've seen pickup just over the last couple months is internal sale of shares. We're seeing some shareholders, especially minority shareholders, kind of get kicked in the rear because of what's been happening to get out, or majority shareholders wanting to buy their minority shareholders, trying to position themselves for the bounce back. So there are a lot of reasons why people are choosing to do valuations, and another common reason we're seeing is just a general understanding of what my worth is, and for business planning purposes, so they can really understand how to position their firm to grow in the future. Of course, the million-dollar question is multiples. What are multiples? How have they changed? How have they shifted, especially over the last few months since we've been dealing with this pandemic? Multiples haven't changed radically. There has been a softening. We have lowered multiples a little bit, but it hasn't been a lot. We have added qualifying language to our valuation letters, especially a lot of firms that we're doing valuations for, the effective date is either the end of 2019 or it's the end of the first quarter of this year, and they really haven't seen the effects of this pandemic flow through their companies yet. So we're having to qualify the language in all of our reports because we really don't understand the true extent of what it's going to look like in the third quarter or the fourth quarter of this year, and really to some extent all of 2021. So that qualifying language is now present in all of our letters and probably will be for some time to come until we reach a state of normalcy here. Really what we're seeing, and Steve will talk about this more on the mergers and acquisitions side of things, rather than multiples changing a lot, we're seeing terms change quite a bit. And what we're seeing is the terms change really to favor the buyer, to give them a little more flexibility if we are seeing some issues with the housing market. Steve will go into that in a little bit when he touches on M&A. In general, multiple ranges. We're seeing them anywhere between 1.5 and 5, and this was really the case even before the pandemic hit. I will tell you that multiples between 4 and 5 are few and far between. Those are for firms that are very large, operating in major metropolitan areas. These are firms that can have the ability to capture a lot of market share. They have a diverse concentration of sales amongst their agents. So 4 and 5s do exist, but they're fleeting. They're not very common. And then obviously, multiples are what we use to value companies for companies that are profitable, for companies that have a net operating cash flow or what we call adjusted EBITDA to apply it to. But not all firms that we work with are profitable. But just because a firm is not profitable, it does not mean that there's no value. We're definitely seeing, as long as there's agents that are producing, there's going to be value to those firms. And in that case, when there's not profit, but we do have producing agents, we're using a different approach to valuation called the gross margin approach. It's also known as the company revenue approach, and that's more of a top line approach to valuation. Just like softening multiples as a result of the pandemic, we are seeing a softening in the valuation rate on the gross margin approach. So it's kind of equal there. Next slide. Factors that affect marketability, really, it's the same as it always has been. One of the biggest factors we look at, and Steve will address this more, is comparable sales, what's going on in the M&A market. Financial trends, we're seeing, obviously that's something we look at very strongly, not only what's been going on in the last 12 months with your firm, but also how it's been trending over the last several years. We do a deep financial analysis when we do evaluations. We look at several years of performance. That's a big factor. Concentration of sales, owner contribution to sales if the owners are listing and selling, owners' compensation. We look at leadership. We look at where they're operating regionally. Obviously, national trends affect are factors that affect marketability. And then obviously, as it's listed here on the slide, we look at to see if there's any ancillary services and how that's working with the brokerage, with their brokerage operation. So really, bottom line is valuations. We've seen definitely a pickup in valuations. Multiples are trending a little bit down, but not a lot. We're going to continue to monitor them as we see how firms recover and how they bounce back. And really, it's a lot of moving parts here, Steve.
Yeah, it has been in all of our work. And next slide. So let's skip ahead to the market for acquisitions and mergers. It was actually very strong, both in the last quarter of 19 and the first quarter of 2020. We had a half a dozen transactions, and 3 or 4 in particular, that were all but done, where the financing parties to the transaction in mid to late April pulled the plug on financing until they got a clearer idea of what would happen. That's a good example. So the first quarter of 2020, things were very strong, and the housing market was, of course, for many firms in many markets, the housing market was roaring along just fine. The good news is, as we're recovering now, we saw a bounce starting early May in pending contracts. We're starting to see activity and interest pick up again. Most acquirers are willing to get engaged now. They're willing to negotiate now. But most also are wanting to push closings out a little bit further than normal, just to see how much stronger or longer this economic or housing rebound will carry our industry. And no one's really sure about that at this time, although very positive signs throughout the country in continued strength in showings and pending contracts. Next slide, Bo, please. So there are more interested parties today in all kinds of different brokerage companies than ever before. We had, and we've written about this before, up until the end of 2017 to early 2018, the market for M&A was dominated by Realogy and Berkshire Hathaway Home Services, and they were acquiring many fine, large brokerage companies. One Realogy brokerage, the new name for NRT, announced at the beginning of 18 they were going to pull back and de-emphasize large acquisitions. And they have stuck to that course ever since. Home services took a different tact and really didn't say no. They just got far more selective and reduced their price targets and softened the terms of the transaction more in their favor, as Scott said earlier. But now we have a whole number of new entries. Probably one of the ones many people have heard about is Peerage Realty and Peerage Capital out of Toronto. They have made 2 acquisitions in the US. They have several more pending, which have also, as we mentioned earlier, kind of been put on pause. They are still discussing acquisitions or investment in firms with a half a dozen that we know of, and there are probably a half a dozen others that we're not involved in at this time. Could be that many. So Peerage is one, but there are 4 or 5 other entities. The one that is relatively visible is Corcoran Global Living, is a private-backed entity in California with rights, I should clarify, to use that brand, but it's actually private capital, both family and institutional wealth, backing a group of leaders, experienced hands, to invest in brokerage companies. They have completed one transaction. That was an investment in Zephyr in San Francisco, one of the top firms in that town. And they are just in discussions with, best of our knowledge, 6 to 8 other companies, mostly in the western part of the country. That's a good example of at least 3 other entities we're aware of who are either private equity backed or just private money backed, interested in investing in brokerage companies. Next slide. So there's this wide variety of investors and acquirers. Interesting enough, this new group, while they will do on occasion acquisitions of 100% of brokerage companies, for many of them, their preference is to buy 55 to 70 to 80% of the equity of a brokerage company and leave the owner with equity, if you will, as a form of incentive and earnout for the leader of the company to continue to do what they have been doing. And we're seeing more variations of that among these emerging investor acquirers throughout the US and very active. Now, when we say very active right now, here June 24th, they're interested in discussions, doing analysis, looking at our valuation reports, and discussing and or negotiating deals, but they're all hedging a little bit in that they may push the closing back longer than may have been in the past to kind of see where does the new normal housing market settle in terms of housing sales in the US. So we have this great new flexibility that we're seeing from a wide variety of companies. And by the way, we do know, because we've worked on a few, where Realogy Brokerage and Home Services will do strategic combinations within markets where they already own a brokerage company. They're not bashful about that at all, and they're still very active at it. So I don't want to confuse that with Realogy and Berkshire Hathaway Home Services are, let's say, at the very least, a little reluctant to go to brand new markets to acquire brokerage companies at this point in time. Next slide. So we expect activity to increase in the months ahead through the end of 2020 and into 2021. Why? Well, there's just fewer for good candidates for many to acquire. There are not nearly as many as there were 3 years ago or 5 years ago. There are just not as many that fit the profile, for instance, of a Realogy Brokerage or a Berkshire Hathaway Home Services or even Peerage. They all have their kind of makeup, and they don't tend to acquire brokerage firms with radically different business models than the ones they're already invested in, particularly in the same market where they're located. So there's fewer really good candidates. And so when there are good ones, there's more people interested. Second, the national brands, through a number of vehicles, including advancement on future franchise fees and outright assistance, are looking to get their growth going again by providing financing vehicles for their own affiliates to roll in either other affiliates or brokerage firms from outside their networks, as well as offering financing to, let's say, an independent broker who may want to join their brand and will help them buy one of their brand companies. This is very widespread, and there's a lot of different vehicles available from national real estate companies to do this. Everyone, even before COVID became a fact in our lives some 3.5 months ago, we could see from the Real Trends 500 and Nation's Best reports that a majority of the large brokerages, say the top 500 in the country, were having trouble growing organically or growing their market share. That's true of most of the national companies as well. And so roll-ins and acquisitions become a very important, if you will, arrow in the quiver for growth. Lastly, another point, obviously, is the competition for agents has gotten higher and tougher and stronger in almost any market, every market in the country. And that's a fact known to everybody listening in today. We are starting to see interest by brokerage companies in acquiring teams who produce good business volume, who operate at least in a similar way to their existing brokerage, as another way for them to grow, because there are now, and we are starting to see an increase in our valuation for teams, because there is some interest both by teams in becoming sellers and brokerage becoming their buyers. Next slide. So another thing that's happened that's relatively new is many people listening in are well aware of new lower cost brokerage models with high technology, whether they're HomeSmart, Realty One Group, EXP, Fathom, JP and Associates, and I could go on, United Real Estate. These are all really good, fast growing brokerage companies with just a lower cost structure for their agents. Well, several of these have raised money to acquire firms of a similar model in other markets. And they are looking at different fits, and they offer reasonable multiples and reasonable terms. So we're starting to see capital flow into that sector, and that's creating increased activity for buy in between brokerage companies who are lower cost models, Scott. And I know we talked this morning early, and we're back to near record levels of valuation in the month of June.
Of all brokerage types.
Of all types.
Traditional, flat fee, we're seeing it all.
Yeah, and we've got 4 transactions under contract right now, and 6 more we would expect to get under contract before the end of July.
Business must go on.
Business goes on. Another slide, Bo. So we expect these main drivers to continue. Consolidation in local and regional markets, regional expansion to drive more core or ancillary business opportunities. We're actually working on one of those right now, where the main upside for the acquirer is they can bring their mortgage and title to play. And our client in this case does not have mortgage and title. So there's a big upside then for the acquirer. Consolidation among this lower cost segment of the brokerage market. And lastly, aging of the broker owners of the realty business. And no pun aside, because everybody knows Scott and I are both under 35 and will live forever. But the truth is, a lot of brokerage owners and team owners, by the way, we're encountering are over 65, 70 years old, and they're starting to think about their exit plan or their succession plan. So we're working on companies through many of those challenges and ways they can accomplish that. Last slide. Last, I'd like to share this. While we are and have been forever proud to represent significant firms like Long and Foster, Alon Pinnell, and Barbara Corcoran when they sold their companies, our average size client is actually between 100 and 300 agents and has revenues between 6 and 25 million. And you can see the numbers that we've been involved in our 33 years of this work. We'd be honored, of course, to answer any questions you have. And we are recording this. And if you'd like a copy of the recording, please feel free to email myself, S. Murray, Murray @realtrends.com, or Scott Wright at swright, WRIGHT, @realtrends.com. And we will be glad to forward a copy of this recorded presentation to you. Now, before we go, we'll check and see with our partner, Bo Freeze, a little behind the scenes, if we have any current questions.
Okay, first question.
First question is the percentage of seller financing to outside financing. That was our question. Let me put that in a different context. That may relate to how much cash should I expect to get at closing or pay at closing, and how much is an earnout, which is, or a note, which is seller financing. We are seeing right now between 25, the variance is 25. I mean, we've had a couple under contract earlier this year that were as high as 65% cash, with the rest seller financed. We may be able to still get those done because those particular businesses are still doing extremely well. Most of the new transactions we're working on, it's 25 to 40% cash and the rest in some form of seller financing. So another question has come to us about in pushing out the timeframes for closing, how much was I talking about? When you sign a letter of intent to acquire a brokerage, a normal closing period, for instance, might be 30 to 45 days to then get to a closing. Now we're seeing it's more like 45 to 75 days to get to a closing. So that it's about another 30 days of push on how long between signing of letter of intent and the actual close of a transaction. Okay, a third question also goes back to kind of the first question, what percent of cash and what percent of seller financing? And I think I've answered that one, so we're good there. Scott?
In a little part of that,
Yeah.
that question was with terms. And as mentioned on the term side of thing, we're seeing it a little more friendly towards the buyer. And
Right.
We're seeing a lot more transactions, including stop loss provisions and various provisions that are pertaining to specific market activity.
Right.
There was a recent deal. What was an example?
For an example might be, to further answer the question, is we may see, instead of a 3-year earnout, we may see a 5-year earnout. The earnout payments may be deferred for 3 to 6 months before they commence. Scott mentioned the stop loss provision, which simply states that if, for instance, MLS sales fall in any given quarter, compared to the same quarter the year before, either party may defer the earnout payment for that quarter. It's just more flexibility in how the buyer is going to pay for it and giving protection to the buyer to get them to close, as opposed to worrying about where housing sales will be in 3 to 6 months. Good point, Scott.
So typically on the growth, so the question was, what's the range that we see on the gross margin or company revenue approach? A lot of times we're seeing the range between about 20 to 35%. Sometimes it could be more if it's a really strong company that say had just a bad last 12 months, but still a lot of strength in that market, a lot of potential going forward. But in general, that range is 20% on the low side. 30 to 35% is probably the most common number we're giving out to valuations right now, and that's 30 to 35% of the company dollar. That's that number. Next question was, what is our turnaround time to complete evaluation? Once we receive all the checklist items, and there's a long list of items that we need in order to complete evaluation, once we receive that, the turnaround time is typically between about 7 to 15 business days, and that just really depends on kind of how our pipeline's looking in terms of our valuations that are waiting to be done. I think that the question that was being asked is what are we seeing for retained company dollar over the last probably 6 months to a year. We are seeing that this is a trend that's been going down for years. We actually saw it flatten out in 2019. Nationally, it's probably still somewhere around 15% retained company dollar, but it depends on the region of the country, depends on your model. We've seen, obviously in the West Coast and in Canada, and if you're a flat fee company, your retained company dollar is going to be a little bit lower. And they manage to that with their how they do their operating expenses. But it really depends on where you're operating regionally. But nationally, it's around 15%, and it is trending down a little bit.
I'll touch on it. Right? Someone has asked the question of the cost of our service. Valuation, depending on your brokerage, what kind of brokerage you are, brand name you are, can vary roughly between $4,000 and $6,000 to do evaluation. That's a flat fee. It also comes with 4 hours of our consulting time, and frequently we help people get small acquisitions done within the 4 hours.
Yep.
So we help them. When we represent a brokerage company to sell them or take them to the market, generally it is what we call a modified Lehman formula of a percentage of the first $1 million of value, a lower percentage of the next million, and then a lower percentage of any millions thereafter. I prefer not to be real specific because we do discuss that with clients depending on the size of the firm, the complexity of the transaction. It may vary a little bit, but generally that's how it works. And if you shift from a valuation and then ask us to sell you or work with you to sell your firm or buy another firm, we don't then charge another flat fee to our clients.
And to expand on that a little bit, what's included in a valuation is, first of all, a detailed financial analysis of your company. We usually look back 3 or 4 years just for trending purposes. As mentioned before, valuation is typically based on the last 12 months. We include that financial analysis in about a 25 to 30 page narrative report that really goes into the nitty gritty of fair market value and the approaches that we took to the valuation, the factors that affect marketability. The valuation also includes a benchmark report that scrubs up the performance of your firm with your regional peers. And like Steve said, it includes consulting time to help structure if it's part of any kind of a transaction, whether it's internal, external, that's all included as part of that base fee.
Yeah. Hi, somebody asked the question, how much value, or is there a value reduction between two firms of everything is equal between those two firms, except one is under a long-term franchise agreement and one is an independent broker able to sell to whomever they choose. And what we have said in our valuation practice and what's happened to us in the real world for the last 25 or 30 years is it may be, and it could be, that the firm in those circumstances who is franchised may get a little less or maybe not as favorable terms simply because a franchise agreement, most of them restrict the owner of a franchise broker's ability to sell to the open market. There may be fewer qualified buyers for that firm. Let me be very clear though, that does not mean that we come out and say that a franchise broker, same everything to an independent broker, is always less valuable than the independent broker. It may be. It just depends on what the marketplace for that franchise broker or that independent broker is in that particular metropolitan area at that time.
The question was, is there generally an interest rate attached to the earnout? And the answer is yes. Typically, it is about 4 or 5%. That varies depending on what's going on in the markets, but that's the standard rate that we usually see. The next question was, what kind of a discount are we seeing in all cash acquisitions? You know, obviously, in an all cash acquisition, that presents a lot more risk for the buyers. So there is a pretty significant discount, and we see that between about 20 and 40%. We've seen that it range pretty widely, but 20-40% is a decent range that we're seeing in all cash transactions.
The question is, how do owners' benefit affect EBITDA calculations? In the valuation process, we're going to take all of the owner's benefits, salary, benefits, auto allowances, club dues, bonuses, retirement plan contributions, planes, trains, and automobiles they own. We've seen it all on the valuation front. But everything paid to the owner or on behalf of the owner paid by the company are added back to net income, along with things like depreciation, amortization, and interest expense. And we have to normalize all these things. Then we will deduct an amount equal to what we call the comparable cost of management. This is, in our data and our experience, what it would take if I bought your company and I'm replacing you. How much would it cost to replace owners' services? We call that comparable cost of management. So that's how owners' benefits are treated.
Yeah, this next one is, what kind of multiple are we seeing on teams? And you know, obviously, that varies widely. It depends on what kind of a team we're dealing with. There's different kinds of teams out there. Yeah. There's the convenience team, the personality team, then the business system team. And really, the teams we're seeing with the highest multiples are the teams that have some kind of a system, a marketing system that can be transferable to somebody else. So if the team leader or the rainmaker owner, whatever it is, sails off into the sunset or gets hit by a bus, whatever, there's a system that they can transfer to somebody else that can continue to generate near or the same amount of leads. And obviously we would hope that there's some kind of a listing agent that can close those leads as well. Those type of teams are seeing higher multiples. In general, these multiples are not going to be as high as brokerage firms based purely on the concentration of sales. And in a lot of times we do need to have that team leader present after a transaction to transition that business over to the new owner of that team or that system in order to maximize how we're seeing that get paid out. But in general, it is going to be on the lower side of what we're seeing for multiples.
Right.
So the question is just a little more color on retained company dollar and how we're calculating gross margin in company revenue approach. So basically, retained company dollar is what the brokerage firm gets to keep after the agents are paid. So for a traditional firm, it's their portion of the split plus any fees. And for obviously non-traditional firm, it's after the 100% commission is paid. It's the total of all their fees, whether it's a transaction fee or a monthly fee, and then that's the percentage kind of what the brokerage gets to keep. And that's on the top line. That's before operating expenses are being paid. So that, again, that company dollar can range between, we've seen obviously high single digits on the low side up to, 25% still, for firms that are providing a lot of services to their agents, operating, especially in the northeast part of the country where we're still seeing those higher retained company dollars.
Yeah, and let me add, when Scott referenced the 20 to 35% of retained company dollar and gross margin as a valuation factor, let's not get confused. The number he gave you, 20 to 35%, is the valuation of a brokerage might be 20 to 35% of that net company dollar or gross margin. Further, that just tells you the value of that firm. It doesn't then reflect, well, what percent of that value are you going to pay in cash or in an earnout, et cetera.
Right. So if there's $1 million of company dollar and we fix a 35% valuation rate to that, the fair market value of that firm would be $350,000. But like Steve said, that could vary up or down based on the terms agreed to between the buyer and the seller.
Right. So the question is, what are earnouts based on? Is it gross commissions? Is it profit? Is it company dollar? While we have seen them based on all three of those, 98 out of 100 are based on company revenue or gross margin, net company revenue or gross margin. I mean, truly 98, 97 out of 100 will be based on gross margin or company dollar. That's where earnouts are. And I won't go into the lengthy explanation other than to say that's a number that neither party wants to see manipulated or changed drastically downward for any reason. And I'll leave it at that. I mean, for instance, profit can be affected by a lot of things that the new owner might want to do in terms of spending or investing or changing commission plans. But neither buyers or sellers want to see the gross margin, net company dollar, go do anything but at least stay where it is, if not grow.
So the question was, does the value of ancillary services, mortgage, title, escrow, insurance, I guess it could be two-tiered. Does that affect the overall value of the entity, and are the multiples different than what we're seeing from the brokerage firm? Steve?
Yeah, I mean, So the answer is this. We will, first of all, just having them does not make your brokerage more valuable. Just if you have a mortgage MSA or a joint venture or mortgage brokerage and you do title and or escrow property management, but having them doesn't make your brokerage firm more valuable. We value those generally. If they're standalone entities, we value them as standalone entities. In the case of, for instance, a marketing service agreement and the revenues are on the brokerage financial statement, yeah, I mean, could help the value of the brokerage company. But we tend to value these separately, and we tend to apply very similar multiples to title and escrow and residential property management, to some extent property casualty at times, although there are some variations in that. Mortgage, we have to look more carefully, primarily because you have to separate out the refinance business from the purchase money segment of the mortgage business. And it also depends on what model you have. Is it a JV? Is it a mortgage banking firm? Is it mortgage brokerage? You know, what kind of model is it? And the multiples will vary all over when you're looking at that. The question is, what's the typical ROI a buyer should look at? Rather than answer that specific question the way it was asked, we have a general rule of thumb at Real Trends, which is you should structure deals where you're going to get your invested capital back within 3 to 4 years, no later than 4, and as close to 3 as possible. You should be able to get your capital back, your invested capital in the deal back within 3 years. So I suppose you might say that that indicates an ROI of 33.3% per year. But truthfully, it's just as normal that you earn your investment back in 4 years or less, and leave it at that. Somebody asked, how do we market firms in light of confidentiality? Um, what I want to say, at least here at Real Trends, is that there's nothing we take more important than confidentiality. We kiddingly share with people that we follow the Benjamin Franklin School of Confidentiality, which says 3 people can keep a secret if 2 of them are dead, to put it kind of bluntly. One of the things we're most proud of is that, at least on our side of things, we have not had a breach here in 30 some odd years, 33 years. There are things that get out. It's funny and interesting that often it's our own selling clients who the leak comes from. It does not happen very frequently in our industry that it comes from the buy side. Now, there are always exceptions, but what we require for any buyer who's interested in a client of ours is that we're first going to know them. Second, they're going to sign a confidentiality agreement with us. Third, they're going to know not only would our clients have remedies against them if they breach, but you can bet this, if somebody that did that to one of our clients, they would never get a look at another one of our clients, ever, period. So we enforce it by knowing who these buyers are mostly, and emphasizing that we have to know who they're going to talk to within their own companies. We ask for private email addresses, private cell phone numbers, so that we don't end up talking to their front desk all the time. And the same goes for the seller side, our own clients. We take it very seriously.
There's a slide that gave an example of a multiple range. And what that slide was actually just showing was if the multiple was in that 3.75, 3.75 in 2019, that might be down at 3.25 or 3.5 now. So multiples have just slid down. That was more of an example than anything. And to answer the second part of that question, is that a multiple of profits? Yeah, it's a multiple of adjusted EBITDA. So yeah, profits obviously normalized after all of our add backs and adjustments.
So we had a very good question as the last question of this presentation, and that is, generally, do acquirers maintain the existing firm's commission plans? And my answer is, if they don't, there won't be much company left. Bottom line. So to answer your question, in almost all the cases we have worked on the last years, many years, almost every buyer of another brokerage firm leaves the existing commission plans intact. Now, they may do that through the end of a year, 12 months from the closing date, or through the end of the calendar year, and then propose a new plan. Sometimes they will take their own plan and the new company's plan and create a hybrid third plan. And there's all variation, but generally speaking, most acquirers, the last thing they change is agent commission plans and fee schedules.
Great questions, everyone.
Great questions.
Yep.
Anyway, thank you for joining us today. Scott, any last comments?
Nope.
You're good?
Enjoyed the time.
We wish you all the very best. Please stay safe and healthy, and we'll visit with you again. Thanks.